Welcome to Business Beyond the Game. My name is Eric Jackson, and I'm joined today by the global co-heads of Goldman Sachs' sports franchise and investment banking, Carey and Dase. Gentlemen, how are you?
Great.
Doing great, Eric.
Thanks for having us.
Oh, I'm so glad you guys are here. How's it just been, working in the sports industry right now? And obviously, despite some economic headwinds, we're seeing so much investment growth, investment in the sports space right now. On your end, what's it been like just to see that?
So it's been phenomenal to look at the values. These are all monopolistic assets, but to watch the valuations grow the way exponentially, whereas revenues have grown, but not to the same level. And again, this asset class has been established for a long, long time. The performance has been great, but it's been pretty phenomenal couple of years run right now after COVID.
I was going to say, Dave, what makes it such an attractive asset class? If we can just start from the beginning of, why are we seeing these valuations, everything just continue to rise and,
Yeah, look, I think there are a couple of things that really drive that. I think most of all, one, it's unique, right? There's scarcity value, right? There's massive scarcity value. There are only so many of these teams which are out there. Two, it's a place to aggregate audience and community. And whether it's sports, whether it's any other element of business today, people are trying to aggregate community and develop those direct relationships with the end consumers, which is in sports. It's the only way you can really get a live audience to tune in. And so as you think about the ecosystem of traditional media going back, really over decades, sports is the linchpin to that and what is holding it all together. And that's incredibly attractive. And then I'd say from a return perspective, and we can talk about this a little bit later, but this historically really illiquid private asset class, which now is starting to see more and more liquidity. And so the return profile of these assets, there's an enormous amount of capital out there, be it institutional capital or individual capital, that really wants to get exposure or access to this asset class.
Right, no, definitely. And you guys have recently, you merged two divisions, right, over at Goldman. Now you guys are, combined under one roof in a lot of ways. Is that just a response of just the international investment in sports, or, what was the thought process behind this?
Well, Goldman buys and sells more companies in the world than anyone else. We have a great sports practice, always had been, from an M&A side, which is very episodic, to a lending and project side, which we really spent a lot of time on. It was really, we have these four stools at Goldman Sachs. We represent some of the richest people in the world who want to get exposed to this asset class. And it was really there before. It was really a coordination. So I call it just tying the shoelaces a little tighter, so we're responsible for it.
Yeah, I think we want to become more systematic in terms of how we're covering the space. The asset values have grown so dramatically that they're significant companies, and the whole broad ecosystem, again, right, you talk about teams, you talk about valuations, you talk about leagues, sports rights, etc. But when you think about ticketing and gaming and data and analytics and events and everything else, having a holistic view and really tying that together such that we can do what we do best is really cover clients and really invest in clients, and ideally find real ways to add value and impact the ecosystem, which again is evolving. We think it's going to continue to evolve. And it really touches I'd say the four pillars. We have this concept, one Goldman Sachs or one GS, and so it really touches that from an investment banking perspective. And all those clients we talked about, it touches our sales and trading groups, because many of our largest clients run hedge funds, many have bought sports teams, and the whole family office focus for the firm is very, very significant, so it's synergistic and ties in with that. And then asset management, we talked about how institutional capital is looking for more ways to invest or get exposure to the asset class, and it ties in there. And then we have a very significant, massive private wealth management network, which many of those clients want to get exposure to the asset class as well. And so it's kind of a classic 1GS business, and so what we're trying to do is just get more organized and become more systematic in terms of how we're thinking about interacting with all the clients and everybody in the ecosystem.
You mentioned hedge funds, I was just thinking of, who are the kind of people who are coming along, right, and investing now, right? I think before, right, sports team owners were maybe owned family businesses and, sold those for, fortune. Now it seems like hedge fund owners and more people in that space, what do you guys just think of the profile of the person who is coming along now?
Well, first of all, if you take a look at wealth, there's more billionaires in the United States than there are, multiple than any other country. So that you've seen, for example, 10 of the 20 owners in Serie A, the Italian league, are now U.S. owners. So you have this great wealth creation that has a lot to do with the investment area, the stock market going up, and asset class going up. So you're seeing that first. Second of all, the experience of a lot of these owners are also owners of teams in the United States, and bringing that level of governance. Why the U.S. teams are so much more valuable from a revenue perspective than some of the other leagues is the overarching governance that you're seeing with the major leagues in the United States. And that governance, that protection, that non-protection them from over-leveraging, centralized revenue, all is producing, I create that somewhere else.
Is that experience, like having their own? What do you mean by that exactly, the governance?
So governance, so the leagues, the NFL, the NBA,
right.
Their oversight of the team ownership, wherein Europe, the leagues basically have governance, there's financial fair play, and they sell the media rights. The leagues tell them, like NBA has team vote. If a team is not doing well, the league actually steps in, helps them thinking about how to generate things. And a lot of the revenues are much more shared. So it's not just, that one sale of the rights. So it's very, very strong. Started with the NFL. The NBA is great. Hockey, Major League Soccer, Major League Baseball, all of them. It's the commissioner is the man who has the keys. In Europe, it's really the owners, and then they have to abide by certain rules.
Yeah, look, the evaluations have gotten to the point, certainly in the major sports leagues, that there are very few people. Well, there are more billionaires. There's still, again, this goes back to the scarcity value, right? That there are just very few people who can step up and write the entire check. And so I think that cuts two ways. One, it's an amazing opportunity, right, for those people to get into that position. But two, it also talks to this evolution of the ecosystem where you are going to need more outside capital, institutional, individual capital, right? And that's why you've seen this pretty significant step up in limited partnership stakes. You talk about financing, you look at the Commanders' financing and how that ultimately came together. Enormous creativity, enormous depth of capital to try to put that together, and we're only going to see more and more of that, and we're going to need to see more innovation over time to continue to see this acceleration of sports teams' values.
You mentioned the ecosystem, like tech and media and this convergence. Like, what areas are you seeing the most capital? Is it R&D? Like, where are you seeing the most investment coming from?
Yeah, I think in terms of the teams or in terms of just the broad,
the broad landscape.
Yeah, clearly for those who have the ability or their desire to own a team and get in, right? There's seemingly endless amounts of capital, although it's complicated in terms of who can afford it and who can ultimately get in. There's a lot of investment though going in, call it the picks and shovels type businesses, right? That are around the sport ecosystem, and so you can think about gaming, you can think about e-gaming, right? You can think about events, you can think about a whole bunch of the data and analytics are massive opportunity, right? And so you can see tangentially how many of those industries have developed in other sectors, and there's a lot of focus on that. So we see a lot of investment capital going into those types of businesses.
But I think one of the real premises is the fan following. Someone like a Barcelona has 400 million followers. It only makes money from 1/10%, and if they can make money from 0.2%, so it's the digital age, it's grabbing them. It's how do we in the digital age attract them, and that's what you're seeing a lot of people thinking. This conglomeration of different clubs, different parts of the world, and creating it up in where they can connect.
Is that why you think maybe a Yankees and AC Milan situation, right? Or these different examples of teams partnering with other global entities and within the portfolio? Would you say that that's a crossover? Maybe leveraging another brand against your own.
Well, again, you always had that in the old days. It was Man U and the Yankees. Now Jerry Cardinal, Redbird.
Yeah,
it's been associated, but it's getting the exposure. It's getting the exposure to following that brand. Once that brand gets followed, AC Milan plays in the United States every year, growing that, which means Serie A on TV. Are you going to get better rankings? And flip side with the Yankees, the growing, Major League Baseball plays in London every year. NFL plays. It's all about media. So they're talking about playing in Madrid and Berlin now. It's all about growing eyeballs on the TV or seeing it, creating more creating more money.
Yeah, no, definitely. And obviously we keep seeing these media deals, right? Escalate. With the coming team evaluations going up at the same time. Is there a ceiling, guys? Dave, Greg? I feel like most people are like, oh no, we're going to keep continuing to rise, but I would imagine eventually, right, there has to be a ceiling.
Well, I don't know if there's a ceiling, but definitely, it's been pretty dramatic growth, right? Whether it's been 10x over the last decade, right, in some of these franchises, some of these leagues. which is really dramatic. So look, you're definitely gonna have a deceleration, right? I don't think you can go on at that kind of incline or that slope in perpetuity. But I think going back to this investment in this direct-to-consumer concept, right, and the disruption of the RSN market or the evolution of the RSN market, it's, there's going to be a little bit of step back as teams figure out how do we engage the fan on a direct-to-consumer basis or one-to-one basis. But I've no doubt as this technology improves, as the evolution and the business models change, there's going to be the ability to develop a much deeper relationship, connection with the fan. And there are going to be all sorts of business models that can come out of that, which will ultimately prove enormously lucrative. And I think many of those will come over the next several years that people aren't even thinking about or kind of talking about today. And so, but there's definitely going to be this transition, kind of transition period. But in terms of the the national contracts which are driving this, again going back to what we said at the start, I mean the ability to draw audience and do it in some sports on a global basis, but certainly on a national basis. It's again that scarcity value and the ability to do that. That's enormously valuable real estate, and you see it right in these what advertisers are willing to pay to put themselves or be placed next to this content and these brands. And that's a lot of supply and demand, and so every expectation that will continue.
But if you look in Europe, for example, Champions League is probably going to be up at least 25%, but yet Serie A is having struggled. They may be down domestically as much as 20%. It'd be very interesting what EPL does with their current domestic rights. Their last one was flat, yet a lot of the top 5 soccer leagues, football leagues, their international is growing exponentially. So it's just, again, getting who's following it, who cares, and getting that brand awareness into the marketplace.
So maybe a little bump, right? But then maybe potentially going right. The slope once the RSN and everything.
Well, it's a transition on how people are receiving.
Look, I think they continue to go up. It's just what's that slope? Right?
What's that slope look like? Right, exactly. No,
it's probably a little flatter than it's been in the last decade.
I would be remiss not to have a stadium question for you, Greg. We talk a lot about public-private partnerships, and it seemed like we were getting a little bit away from the public aspect. Obviously Stan Kroenke and others, more private. Do you imagine that the taxpayer will continue to be a very big part of getting these deals done, just moving forward? I'm just curious your thoughts on that sort of relationship, just moving forward and financing stadiums, at least here domestically.
Well, if you look at the evolution, I started getting involved in the 80s for the TWA Dome, the RCA Dome, the Suncoast Dome, which were all basically publicly financed buildings. And what you saw coming in the late 90s, middle and late 90s, is public financing started to dry up, especially in the bigger markets. But also, if you take a look at people like the control of the building. So you basically landlord-tenant versus being owner. If you take a look at the Jets and the Giants, they've spent a significant amount to do MetLife Stadium from Giant Stadium. They all put historically the most amount of debt on, but they went from the 15th and 16th most valuable team to the 3rd and 4th most valuable team in the NFL, right after taking on all this debt. Why? Because it's control of the building, controlling of the asset. But and also you saw the G3 program starting with because tougher to get bigger money for the bigger market teams. You saw LA,
the bigger markets,
you've not seen that level of investment. But as you grow, the middle markets still need to. For example, there was an article today that came out that Levi Stadium has had a $2 billion impact to the economy in Santa Clara. A $2 billion. So this economic velocity, what it creates. Look at the Swifties. What's happened, changing the economy. Absolutely. But having people come in, rack rates, Formula One, all of sports, happens. So there is always going to be this public-private partnership. You've seen more recently, and more public money. This transaction just announced in St. Petersburg with the Rays. The Nashville just did this. The Buffalo Bills. It's always going to be tougher in the bigger markets. But again, you're going to always see this public-private partnerships, and they need it because it is live entertainment, people going around, building the building. And all of these new facilities, it's also the ancillary development. Because construction costs are so much, controlling that ancillary development. You look at Fiserv and the Deer District, you look at Sacramento Kings. Sacramento Kings Arena changed the footprint of downtown Sacramento.
Changed the game in a lot of ways,
and the property values are up 4-fold around the arena. So it's not just how much is going in, it's what's happening and the velocity it's creating.
Wow, I like that. Dave, any
No,
comment
I mean, the
on
only
that,
point,
or-
I live in Atlanta, right, and so you look at the Battery and what they've been able to do, right, Graves and Liberty have been able to do, I mean, it's spectacular, so I mean, I think that's, that's the role model, and it's a direct economic impact, and it's not just the nights of a game, right, there are people there every night of the year, be it watching sports or otherwise, and so, as you've seen enormous success coming out of some of those developments, you're gonna see more and more of that, and that's certainly the theme and the trend going forward.
But you think, funny thing, you go to Barcelona, 10 million people visit Barcelona, 3 million people visit Camp Nou, and 1.5 million spend money. I mean, it's an attraction, it's what is going on. Their museum, their tours make astronomical amounts of money, what is going on, because these are global assets that are known and seen.
The brand
and
is
the
so
activation
big right
around
now.
the building is what you're seeing. That is the next phase is going on in infrastructure.
I would love to get, as we wind down here, I would love to get a hot take from both of you guys. In the next 10 years, what do you think is going to really just stand out? It doesn't have to be crazy hot, but what just, a prediction in the general sports financing landscape that you've seen coming?
Well, first of all, we're going through a whole credit cycle and interest rate cycle, and they're going through credit cycles are interesting. They're great. They're healthy. You got to get through them completely, otherwise you're not in the cycle anymore. So you're seeing more expensive construction costs have grown up, significantly. But you are seeing this attraction of getting back to what Dave was pointing out earlier. This equity capital, this private capital coming into the system, which is ultimately going to help lift up all boats, and that investment, that need for the investment in all the different parts of it, are really, it's already started, but it's going to continue to grow.
Yeah, I don't know if this is a hot take, but we're really bullish on women's sports, right? And you look at the development and what's been happening over the course, certainly over the last decade or so, but really over the course of the last couple of years, right? And you look at the Women's Soccer League and some of these valuations, some of the execution, right? In some terms of some of these teams and what they've been able to do in the fan base and what they're able to draw in. You look at certainly women's sports and what's going on in college, right? And so I think we're really bullish on that and excited about that opportunity. And clearly, going back to the institutional money or the private wealth money, there's a lot of desire to invest in that sector, in that space, and so we think that's going to continue to be quite exciting.
And that's very much in the case in Europe. I was at Barcelona, Real Madrid Champions League game 2 years ago for the women, 91,500. And getting to Dave's point, the fan base has changed. It's much more of a family. So the advertising changed. We're working on something for Lyon right now, the best women's team with Barcelona in the world, with a lot of U.S. players in it. So it is very much the attraction, and that it's, again, in soccer, it's such a pure game. You don't see the players complaining about to the ref, or diving. So it's actually a really cool thing to watch, and the talent is phenomenal.
We just noticed, the Bay Area is getting one WNBA. Angel FC was at the top of our Sportico valuations recently. So absolutely, I love that. That was a great point. My final question as we get out of here, what's the best business lesson that you two have learned during your careers? Don't answer at one time.
Best or toughest?
If you could leave us with one.
Get close to your clients and listen well and really understand what it is they're trying to do and what they're trying to achieve, and really just bring the power of your team, right, the power of the organization, right, to bear in terms of helping them solve their biggest problem.
I love that. Listening, right?
Well, it's funny, I used to teach, of course, at NYU in the economics of investment in sports facilities, and by the third lesson I wasn't getting through, you had to learn how to listen, taught me how to listen again. But that's a very valuable thing. But you're watching, we work with so many billionaires and watching them and then come from another business where they've made their money to the sports. And that attention, what they do, what they're doing well, attention to detail. I go back to Bob Kraft and Jonathan Kraft and how they've grown. They paid 173 million or some on. And now it's 5 billion. And private building, and just watching the way they watch the Jerry Joneses and the Bob Crafts of the world, managing what they're doing, their focus to attention to detail. It's just phenomenal. You'll learn every deal we do. We learn a little bit from that owner, how they suck you in and make you work for them, but also it's a very phenomenal thing how these bright men and women have running businesses, and how you've learned from each one of their special traits.
Love that. Well, there you have it, folks. Thank you for watching Business Beyond the Game. This is Dave Dase and Greg Carey, global co-heads of Goldman Sachs' sports franchise and investment banking. Gentlemen, thank you for coming.
Terrific. Thanks,
Cheers,
Eric.
man.